Hey guys, Toby Mathis here, and today we're going to do reaction videos to popular TikTok tax gurus. My staff grabbed a handful, and we're just going to go over them. Hopefully they're not horrible. Sometimes, literally, I'm left shaking my head, but we'll see what they brought us today. Let's start.
No problem. I told the IRS that I am non-taxable. That's not the same thing as tax exempt, because if you're tax exempt, you're asking permission to not pay taxes.
Okay, I don't even know what she's talking about right there. Tax exempt for like 401ks or 501c3s. She's just saying I'm not taxable. This is going to get interesting.
But I am non-taxable because I am a living woman who does not reside in the DC zip code.
Okay, that is not a thing. Let's just get that right out the gate. The IRS has dealt with this. There's 3 or 4 cases. I could think of Ward, Cooper, where people went to jail for tax evasion. This is, I can already say, holy kashmoli, if this is the whole, hey, I don't live in DC or a territory, therefore I'm not subject to taxation. That's already been decided. There's even a revenue procedure on this one. This is orange jumpsuit, and it's already staring us right in the eye.
I sent it as an affidavit, so I gave the IRS ample time to respond to me if they have any rebuttal at all. And if I do not get a response, then I assume that, I can continue living out my rights as a non-taxable living woman. I had my affidavit notarized and sent it certified mail. This was September 3rd of last year. I did not receive a response. Oh, and I also included a W-8-BEN that I filled out with the best of my ability. And
why are you even doing that if you're supposedly non-taxable? Like, hey, I'm not going to pay my taxes, and if you don't tell me that I'm wrong, I'm just going to assume that I don't have to pay taxes. That's not how our system works.
I included also a Google Maps printout of my exact coordinates of where I domicile, just to prove that I am not within the DC.
Hey, I'm going to commit tax evasion. Here's where I live. What could go wrong?
Zip code. And they could find me if they really wanted to. Oh, and another thing is I mentioned that I am not an employee of the state or federal government in any way.
Hopefully she'll be able to have social media in jail, because if what she's doing is what she says she's doing, it's absolutely a crime. Now, there are situations where you could say, I just was mistaken, and they might consider it, but generally, ignorance of the law is not an excuse. In this particular case, do not listen to this person. That's absolutely garbage. It's been decided. You could actually go to the IRS website, just type in, for example, IRS DC resident frivolous argument, and you'll see a whole page dedicated where they go over all the cases. Boom, 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 boom. Probably some that I just mentioned. I remember Ward, I think he got convicted of 3 counts of tax evasion. Smart guy trying to argue, here's what it says. No. This has already been decided. Supreme Court's decided on it. The courts have decided. Revenue procedure already been decided. You are subject to federal taxation if you are a resident of the United States or a citizen of the United States, period. Full stop. Don't play with this stuff. That one, gosh darn it, they had to give me the one where it's like the orange jumpsuit right out the gate. Hopefully this one's better.
Hooray! And you file your taxes and you do not have an S-Corp. This means you're being taxed as a sole proprietorship. You're going to be subject
All right, so right off the gate, it sounds like a business where they netted $100,000. We'll see what he's going into. I just want to make sure that I don't know if I'm catching this video right at the beginning or whether he just kind of skips over that. But you make $100,000. Okay, we get it. And you're a business, so you're getting 1099, or you're making service or some sort of net revenue, net profit in your business.
2 types of taxes. One is called a federal tax, and the second one is called self-employment tax. Now, your federal tax is generally just like your tax bracket. So let's say that's 20%, and your net income is $100,000. So in federal tax, you're going to pay $20,000, and self-employment.
Stop it here. That's not how it works. You have a standard deduction. You have a graduated tax system. So just because you're in the 20% category or whatever category you're in, you're going to pay some at 12%, and it's going to go up, but it's not just a flat tax, but that's neither here nor there. And then also, the employment taxes are federal taxes.
Tax, you're going to pay $15,300. So as a sole proprietorship with no S corp, your total tax is going to be $35,300.
Okay, he's absolutely wrong. He's got the right principle though, but his numbers are off. But let's just say, assuming arguendo, you're at a flat 20% somehow on $100,000, which is going to be pretty tough. It's going to be lower. Then you'd have your employment taxes. You get to deduct half the employment taxes. So the numbers actually, it's old age disability and survivors is 12.4%, and it phases out when you get over $160,000 this year. It's going to go up with inflation, so it'll be a little bit higher next year. And then you have Medicare that doesn't phase out, and actually it has a surcharge when you get over $250,000. So for this example, he is correct at the 15.3, but what he's not correct on is half of it is deductible. So the actual tax on the employment tax is going to be roughly 14.1. I know we're splitting hairs here, but I want to be accurate. So yes, you're paying federal taxes, federal income taxes, and you're also paying federal employment taxes. There still may be state on top of this.
Now, when you're paying all of that money, let's talk about where it really goes, all right now? So the federal tax is going to help pay for things like the military, like raw, our military. That is what federal taxes does. Now, self-employment tax is going to help all our grandmas and grandpas out there, like with their canes, because this is going to help pay for retirement benefits, like their health insurance. That is what self-employment taxes does. So when you go S corp, the number one thing that happens is you stop funding the self-employment
So none of that
tax.
is true. It all goes into a fund and it gets allocated for federal resources. But no, the money you pay in federal income taxes don't all go to the military. The money that you pay in employment taxes actually gets mixed in. It doesn't go into a lockbox. That's why people are always yelling about Social Security, saying it's Ponzi schemes, because it goes into the general fund. But again, kind of principles, the idea is somewhat there, but no, it's not quite the way he says.
Or the grandma tax, you are no longer paying into that. So when you go S corp, you can essentially think about, hey, my self-employment tax is gone. So in this situation, you would only be paying $20,000 instead of $35,000, because that is what an S corp does. It eliminates you funding into the self-employment tax program.
First up, that is not true. The profits that flow out of an S corp are not subject to employment taxes, but you still have to take a reasonable salary. I'm sure he'll get to that if there's still more to this video, but I want to make sure that we are clear. No, you can't just run everything and avoid all of your employment taxes. There's still going to be employment taxes due, because you're going to have to pay yourself a reasonable salary. We'll see if he gets into it.
But when you do that, someone kind of gets kind of angry, right? So here's the IRS. They're like, oh my gosh, that is not fair. You go S corp and you completely get rid of your self-employment tax. How are we gonna take care of grandma? So they're sitting there thinking, you guys come up with the deal. And this deal is now law to do something called run a reasonable compensation. So you come back to the IRS, it's like, all right, cool. How about I pay a little bit, but I don't want to pay the whole thing. So what happens and what you're required to do is run a payroll or a W-2, because when you do this, every time you run payroll, you're paying that 15.3%. Every single time that you run payroll. Generally, the strategies here is let's make our payroll as low as possible. The legal term is let's make our payroll or a compensation reasonable. So let's say we are doing $100,000 in net income. We may choose to run a reasonable salary of $30,000. So in this example, you're still paying that 15.3%. Like, you're still helping grandma out. But instead of paying 15.3% on the $100,000, you're only paying 15.3% on the amount that you choose to run as payroll, which is $30,000. Now, the last thing to consider is that S Corp is not for everybody. An S Corp is like going from a Toyota to a Lamborghini. It is a much nicer tax vehicle, but generally it comes with more maintenance, more monthly costs. And on average, it could be maybe $6,000 a year to maintain your S Corp. Whereas if you're not an S Corp, I don't know, it could cost you $700 a year to maintain
That's
that.
not a thing either, right? The tax compliance costs of an S Corp and a sole proprietorship are identical. The only difference is instead of filing a Schedule C on your 1040 for a sole proprietorship, you're filing a separate tax return called an 1120S. I put them side by side, they're almost identical. It's the same reporting, your books and records are the same requirement, so I don't know where he's pulling these numbers from, but that's absolutely not true. And I'm just going to reiterate, it's not a grandma tax. Old age disability and survivors is exactly that, old age disability and survivors. It's survivors of folks that have had either spouses or parents pass away. There's benefits, there's old age benefits, and there's disability benefits. To keep calling this a grandma tax, I think is not doing it justice. That's not what employment taxes are paid in for. And yes, it is there to help folks, and a lot of people think of it as, hey, when I get old enough, I'm going to start drawing my Social Security benefits. But that's certainly not all it is. And then Medicare definitely isn't that at all. So, and no, the IRS isn't sitting there saying, grr, I want this. They're saying, hey, that there's certain types of income that require the payment of employment taxes, and generally it's when you make a wage. So when you are an S Corp and you take a distribution, you're not taking a wage necessarily. Now, there's not even a requirement that says you have to take a wage if you take a distribution, because you could be a passive owner in an S Corp and take 0 wages because you're not working at all in the organization. For example, if my buddy and myself go into a pizza shop and I don't work in the pizza shop, I'm just the money guy. We could have an S Corp. If my buddy is working in the pizza shop, he needs to get paid for his time, a reasonable compensation. He needs to be paid a reasonable wage. That's subject to employment taxes. Anything else, the profits that get distributed to either he or I, no, not subject to employment taxes at all. That's why people use it. But it doesn't mean I have to pay myself even though I got a distribution. I only have to pay myself if I'm actually doing something, and it has to be a reasonable compensation for that. And there's a whole bunch of factors that the IRS looks at. Generally speaking, most practitioners are going to say, hey, if you're making 100 grand, pay a third of it in wages to the employee, the shareholder, employee. Like the person that's, if it's just you, make sure you're paying yourself a reasonable salary. And the courts usually come down to around a third. That's why people use it as a rule of thumb. There's actually a really good case where it was, I think it was either a tax attorney or a CPA, and they had, I think they were making $200,000 a year, paying 0 employment taxes, and the court said, no, you got to pay yourself about a third of that. I think it was somewhere around $70,000. So that's why people tend to use that. But what he's saying is not true. That's disregard it. But again, there's the essence. Yeah, you got to pay yourself if you're working for it. If you're not working for the S Corp and you're just a silent owner, you don't have to pay yourself diddly squat.
So you want to make sure your savings when you're going S Corp is more than the cost itself. If you are a small business owner or a consecrated that needs professional tax help, head to the link in my bio to become a client.
All right, let's do it. So he's absolutely incorrect again on the compliance. There is a thought that, hey, because you're an S Corp, so let's say you're an LLC, sole proprietorship, you're an LLC, S Corp. State compliance fees, identical. Bookkeeping, identical. Tax prep, I have another return. And so some tax professionals are going to say, here's the minimum I'm going to charge for a tax return. But you're taking the same amount of work that would have gone on Schedule C, and you're doing it as an 1120S. You're going to get a K1, you're going to attach that to your 1040, and that's how you're reporting the income. That's literally how it works. It's not $7,000 a year. There's not a bunch of added compliance. There's none of this, oh, if it's an S Corp, you actually have to have meetings. No, it depends on the type of entity you set up with the state And you're always required to do books and records for any entity, period, for taxes. I don't care whether you're a sole proprietorship, partnership, S Corp, C Corp, they're identical compliance costs with the IRS. So what he doesn't talk about is the benefits of having an accountable plan with an S Corp. And also when you're an S Corp and you combine it with things like your 401k, how you can have a big chunk of that wage go right into your 401k and avoid tax on it. You can do similar things even as a sole proprietorship, but it's not nearly as effective when you have things like the Augusta rule, administrative office in the home, things that are available in an accountable plan that are not available to sole proprietorships. He misses the boat on that. But the gist is kind of right. Yes, the S Corp will save you money on employment taxes, even if you mischaracterize what those are. All right, let's go to the next one. Come on, guys, give me something good. These guys are killing me.
Massage is now a tax-deductible event. That's right.
I got to listen to that again.
That getting massage is now a tax-deductible event. That's right. Due to a recent change in the law, you can now write off up to $3,800 per year.
Okay, I'm already going to get into this. Nothing changed. Massages aren't now tax deductible, right? They've always been a medical expense if prescribed by a doctor. This guy, just by saying $3,800, he's going to say there's an HSA and you could put it in the HSA and the HSA could pay for all your massages. Okay, if it's a medical expense, period. Like if it's a medical expense, it needs to be under the direction of a doctor, period. I can already see where this is going. Hopefully he's not going to say anything really stupid, but we'll see.
Getting a massage. If you're married, you can write off up to $7,600 a year. That's almost $8,000 that you can write off for simply getting a massage.
100% false. Now, you can write off medical expenses out of an HSA up to those amounts, but it's not, this is the massage expense. No, it's health. It's medical expenses. It's for the cure and mitigation of disease. You don't get to just set up an HSA and start covering your massages. You will not get that deduction. It needs to be at the direction of a doctor. Otherwise, it's going to be disallowed.
Now, there are 3 things that you must do in order to write off that massage. Number 1, you must have an HSA. Now, an HSA is a health savings account. It's like any
Called it.
other bank or savings account. You go to a local bank, deposit money, open it up, they give you a checkbook or a debit card associated with the account.
You need to open up an actual HSA account. Yes, there are institutions that will give you an HSA account, but you actually have to set up an HSA account. I would suggest that you do it through a brokerage, like Fidelity or some other.
Number 2, you must have high deductible health insurance. Now, what is high deductible according to the IRS? $1,400. Now, I don't know about you, but that's an awful low deductible. So as long as you have health insurance with at least a $1,400.
He's giving you the single. In every year it changes, so I would make sure that you look at whatever year you're thinking of making a contribution to an HSA, and yeah, if you qualify, you absolutely can do it.
Deductible, you can open an HSA account. Number 3, you have to fund the HSA. Now, you can either go into the account or into the bank rather and open the HSA and fund it all at once with $3,800 if you're single, $7,600 if you're married, or you can simply have a deposit made every time you get your paycheck. So as long as you fund.
He's kind of crossing over of what an employer provided HSA is versus just opening up your own HSA. There's a lot of employers that have an HSA that will come out of your paycheck. Otherwise, you're going to be making the contribution.
The HSA prior to getting a massage, it's 100% tax deductible. Now, if that wasn't good enough for you, check this out. HSAs, you don't have to spend all of the money that year, and you don't lose it. So let's say you put in $7,600, but you only spent, $600 on massages, and you now have $7,000 sitting there. You can now invest that into real estate. So you could use that $7,000 to buy an Airbnb condo, let's say Daytona Beach, Florida. You can buy condos there all the time for $50,000 to $100,000.
Okay, so what he's talking about is a self-directed HSA. You're not going to be able to get that at your bank. You're going to have to go to a self-directed custodian, and you just type in self-directed HSA, you'll probably find a whole bunch of them. And yes, you can actually invest in probably real estate would qualify, but again, I'm going to listen to the rest of this. But if he's going down if he just mentioned a situation where I have $7,000 and I'm buying a $100,000 condo, okay, now you're getting a loan inside that HSA. You cannot guarantee it, and you have something called UDFI inside these. They're just no different than a self-directed IRA or a self-directed 401k. So we'll see if he actually mentions that.
And then you turn it into an Airbnb, that equity in that 2-bedroom, 1-bath condo is now growing 100% tax free.
And that is not true. He just explained a situation where 90% of that was a loan. $100,000, you put $7,000 down, 93% of it would be subject to UDFI and taxable.
Isn't that awesome? So in 20, 30 years, when the mortgage is paid off from the tenant that's been renting it or the Airbnb, you now can go and access that $300,000, $400,000, maybe even $500,000 and use that for something else. You can use it for medical, which would be 100% tax deductible or tax free, or you could simply have a loan on the property. So you pay off the mortgage, get a new mortgage, pull the cash out, I don't know, go buy yourself a Ferrari. And now,
no, do not do what he just said. That is a taxable transaction. If you're under the age of 65, that would incur a 20% penalty plus income tax on top of it. So like you're talking $500,000, you're talking about probably a 50% tax haircut, depending on what your tax bracket is.
it's 100% tax free.
Yeah, no, don't do what he said. HSAs are awesome. What he didn't mention is the growth on that is tax-free so long as it's spent on medical. I mean, he alluded to it. Hey, you can do this. You still have UDFI. It's like these guys love to talk about this stuff and then make no mention of the fact that when you use debt inside of an HSA or an IRA, it's subject to taxation, and that you can't self-deal. I can't pick up a hammer. I can't work the Airbnb. I have to use third parties. If I did it, I disqualify that HSA in its entirety. Taxable event, 20% penalty. Ugh, like right in the gut. So, gosh darn it, these guys brought me like three just, don't listen to these people online. I hate to say it because I'm one of these people online, but I happen to be a tax attorney, so I'm just going to say, hey, listen to tax attorneys, listen to CPAs, listen to EAs, but don't listen to people who just spew this stuff. They're absolutely 100% wrong. They get the gist and they're in the right range, but they're not very good with their precision. And no, if you did what he said, not only are you going to have huge penalties, if you didn't report it right, you could find yourself in the orange jumpsuit along with the first lady who decided that she didn't have to pay taxes because she was part of the DC. Hey, if you have anybody you want me to review, send me the link and say, hey, what about review this guy? Put it in the comments below, or this gal. I love to do these where we're looking at them. I try to do it fresh and try not to sit here and cheat on it. But these ones are like, these are so easy. It's like, come on, guys. What the heck are you guys doing out there? Quit talking about that stuff and quit telling people to do criminal activity online. Right, but if you like this type of information, if you want me to do reviews, put it in the comment, like and subscribe. If you know anybody who's doing any of these crazy things, just forward them this video. Again, I'm a tax attorney. I'm going to hit it to you straight, and I'm going to tell you what you can and can't do. Don't listen to that horrible advice from those 3 videos that we heard today.